Hey everyone, welcome back to the channel. If you're new here, make sure to hit subscribe and join our Telegram group. That is where we break down finance, investing, and everything in between to help you make smarter money moves. Today, we are talking about something critical yet under discussed: the dramatic drop in net FDI into India and how Indian retail investors may have unknowingly become the exit liquidity for foreign funds. If you've been following the IPO space or watching your mutual funds closely, this one is going to hit home. So let's break it down. Let's begin with the headline data. According to the latest RBI numbers, net foreign direct investment or FDI into India collapsed by 96.5% in FY25. That is not a typo. We are talking about a drop from over $10 million to just $353 million. This is the lowest figure India has seen in more than a decade. And yet, gross FDI, that is the total amount of money coming into India, actually increased to $81 million, up by about 14% year on year. So, what's going on here? The key lies in the outflows. A lot of foreign investors have been repatriating capital, that is, taking money out of India. At the same time, Indian companies themselves have been investing heavily abroad, doubling their outward FDI to over $29 billion. So, while money is coming into India, even more is flowing out, leading to a near flat net inflow. There are few deeper structural and macroeconomic reasons for this reversal in net FDI. First, many of the private equity foreign firms and venture capital funds that entered India in the late 2000s are now reaching the end of their life cycles. Most of such funds have a 10 to 15-year horizon, and that means that they are now obligated to exit their investments and return capital to their limited partners. So, we are seeing a lot of planned exits, often through IPOs or stake sales as part of their fund unwinding process. Second, the global macro environment has shifted significantly. With the US Federal Reserve raising interest rates, dollar assets have become more attractive. Safer returns in US Treasuries are luring capital away from emerging markets. So, we are witnessing a classic case of capital flight to safety, where investors rebalance their portfolios towards the developed world. Third, there is also a question of deployment friction within India. While the India growth story remains compelling, many investors find it difficult to scale operations here quickly due to regulatory bottlenecks, land acquisition issues, or uncertain tax treatments. In other words, there is interest in India, but not always the ease or clarity needed to deploy large amounts of capital. And finally, Indian companies themselves are expanding abroad more than ever before. In FY25 alone, Indian outward FDI rose from $17 billion to $29 billion as firms look to acquire overseas companies, access global markets, and diversify operations. While that's a good sign of Indian corporates going global, it also pulls money out of the domestic investment pool. Now, there is a hidden cost to all of this. What does this mean for the average Indian investor? Well, when foreign investors pull out, someone has to be on the other side of the trade. And time and again, that someone ends up being you, the retail investor. Let's talk about IPOs. Between 2020 and 2022, India saw a flurry of IPOs from new age tech companies like Zomato, Nykaa, Paytm, Cartrade, Delivery, and many more. These were flashy, high profile listings with oversubscriptions and tons of media hype. Retail investors lined up in droves to get a piece of what was projected to be India's next digital giants. But here is what actually happened. A large portion of these IPOs was not about raising new growth capital. It was about allowing early foreign investors, venture capitalists, private equity funds to exit. And they exited at sky high valuations. For instance, Paytm was priced at 2,150 rupees per share when it listed. Today, it is trading at around 500 rupees, a decline of over 75%. Nykaa listed at 1,125 rupees and now trades closer to 500 rupees, down by over 50%. Car trade is down over 60% from its IPO price. Zomato has recovered in recent months, but only after spending almost 2 years underwater. These are not exceptions, these are the pattern. In short, foreign investors got out at the top and retail investors were left holding the bag. Now, you might be thinking, okay, I did not invest in these IPOs directly, but chances are you were exposed anyway through your mutual funds. Indian mutual funds, including big names like ICICI, HDFC, SBI, Axis, and Kotak, participated in nearly every major IPO during that frenzy. Not only did they invest in the anchor book, giving credibility to the IPO, but they often bought large quantities of shares through the offer for sale route, which means that they were literally buying what foreign investors were selling. Now, this created a false sense of validation. Retail investors assumed that if mutual funds were investing, the IPO must be safe. But that is not always the case. Mutual funds too face pressure to deploy inflows, match benchmarks, and show participation in hot companies. And the result? Well, even if you did not apply for the IPO directly, your SIP money might have gone into these stocks, and many of them are now sitting on losses in your portfolio. So, what can you do as a retail investors? Well, the big takeaway here is that you need to be cautious, especially during periods of hype. Don't assume that mutual fund participation equals due diligence. Many of them are just playing the same momentum game. If an IPO has a large portion allocated to offer for sale and very little for new business expansion, then ask yourself, why are the early investors exiting now? Avoid jumping in on listing day unless you really understand the business. Most of the IPO euphorias die out after the anchor lock-in ends. And always read the financials. Use free tools like Screener, etc. to look for cash flows and earnings, not just market opportunity stories. Remember, the best investors are not the ones who get in early. They are the ones who get in right. So let me leave you with some final thoughts. The drop in FDI is a wake up call, but it is a part of a larger story. It reflects a maturing investment cycle, a shifting global environment, and yes, a few systemic weaknesses at home. But more than that, it shows that retail investors are still vulnerable to being the last ones and the first ones out. And that has to change. You need to question the narrative, think beyond the headline. Don't fall for oversubscription and anchor backing. Understand who's entering and more importantly, who is exiting. Because in this market, there are only two kinds of investors, the ones who cash out and the ones who subsidize that cash.